All right, what is up, everyone? Welcome back to Tag Economy. I just saw this article and it was talking about how we are in a huge bubble right now in the stock markets, and we can see a downturn of like 40% or more. And I tend to agree, so I want to jump into this article. Here's the article from Jennifer Soar over at Business Insider. She's saying the following: a recession in 2024 would burst the biggest stock bubble since the dot-com craze, sending the market down 40%. I feel like most of the people that I talk to have like a really funny feeling about what's going on right now. It's that feeling of like, this can't be right. I got some friends that I know, pretty high up in the banking industry. And when I ask them like, what's going on with the economy, they just kind of give me that look. I don't know what you would call that look, but it's not a good one. Quick reminder, make sure you subscribe, comment, like, all that stuff. I don't know if it helps or not. My video guy tells me to say it, so I said it. So comment, subscribe, like, all that. Let's continue on. All right, so check this out. Right now, we're in the extreme greed category of the Fear and Greed Index. Also, we can see on this chart of the S&P 500 and its 125-day moving average, we have the S&P 500 line in blue and then the 125-day moving average line in orange. And obviously, the S&P 500 price is way above the 125-day moving average. That means extreme greed right now. And you know the old saying, right? Buy when others are fearful, sell when others are greedy. I also want to show you this other chart really quick just before we go deeper into the article. I think this does a really good job of giving a visual. So in my opinion, if you look at this chart, I think we are in the delusion stage. If we aren't in the delusion stage yet, we are at least somewhere between greed and delusion. I just personally look at the markets right now, and the one word that comes to mind is delusional because it just makes no sense what's happening. So I don't think we are far from hitting a top, going into a bull trap, and then riding that wave down. Now, I'll go over some more reasons why I think we are in trouble, but let's jump more into this article first. So they list a couple key points before they get into the meat of the article. A recession will hit in 2024, according to Paul Dietrich, chief investment strategist of B. Riley. Even a mild recession could spark as much as a 40% stock crash, and that's what he told Business Insider. That's because the market is looking the most overvalued since the dot-com craze of 2001. Yeah, I agree 100% that the markets are looking overvalued, and there's no doubt about it. All right, so let's continue on here. U.S. stocks have hit fresh records again this week, following up a wildly upbeat earnings report from chipmaker. But the higher stocks go, the higher they have to fall in a potential recession. So it goes on to talk about how the economy has shown surprising resilience over the last year, but then it states the following: but a closer look at the numbers paints a less rosy picture of the economy. A slew of economic indicators have fallen into deep recession territory. The unemployment rate remains at near all-time lows, but workers without a job are having trouble regaining employment. Continuing unemployment claims have hovered close to 1.9 million to start 2024. Consumers also look like they're having trouble keeping up with the pace of inflation and elevated borrowing costs. Credit card debt notched a record $1.13 trillion over the fourth quarter, Fed data showed, and it's likely that consumers will soon run into their credit limits. To me, this is probably one of the biggest signs that we're seeing. Consumers are racking up record amounts of credit card debt extremely quickly. It was just 6 months ago, I think it was back in August, that we hit that $1 trillion credit card mark, and we added another 13% on top of that, or another $130 billion since in just the last 6 months. This just shows that individuals are over-leveraged and spending beyond their means. And these consumers are essentially pulling from the future right now. At some point, this debt is going to have to be paid back, which means less spending, or it's going to mean more defaults, which of course is going to impact the financial institutions and lead to tighter credit conditions. It's not going to end well. Let's get back to the article. Meanwhile, inflation likely isn't getting back to the Fed's 2% price target anytime soon. While prices have cooled dramatically from their highs in 2022, the government printed a huge amount of money during the pandemic, around $2 trillion since Biden's presidency, and the inflationary effects of that likely haven't fully worked their way through the economy. And I totally agree. agree. I don't think we have fully felt the effects of the pandemic yet. And I think we have some major pain coming, especially in the commercial real estate market, which is going to trickle down, no doubt about it. Once the money is appropriated and spent, it takes about 2 years for the inflation to actually catch up. And that's why I believe the last mile of inflation going down to 2% is going to be very, very difficult and very slow. It could and probably will cause stagflation we saw in the 70s. And of course, Dietrich added that, pointing to this stagflationary crisis of the decade where prices soared while economic growth was slugged. And let's not even mention that if we measured inflation like it was measured back in the 1980s, it would be way higher. Super convenient for them. The article finishes by saying the following: this current run-up in the stock market is based on the strength of 7 mega-cap tech stocks and the excited betting on when the Fed will lower rates. No one seems to notice that the economy is cooling and there are risks to the economy everywhere. Yeah, I mean, all good points. And there's a lot more he didn't touch on. I'll show you a couple things now. I mean, we've been on an inverted yield curve since July of 2022 now. That's pretty crazy. The last time we had been on an inverted yield curve that long was before the recessions of 1980 and 1982. The Consumer Confidence Index is also at very low levels right now, even lower than they were right before the Great Recession in 2008. There are so many signs pointing to a recession coming, and that's if it's not here already. What do you guys think? Do you agree? Do you disagree? What's your feelings on the markets? Would love to hear from you. Lay out your thoughts below. Catch you in the next video.